This is the microphone. This looks like headphones.
Yeah, it could be a headphone. Yeah.
Headphones, right?
It's going, right? Yeah.
Good.
Okay, yeah. There we go. Welcome back.
Are you ready to do a podcast, my friend?
Yes, I am.
A podcast about the stock market, or do you want to do a podcast about something else? I've taken up collecting teddy bears.
Oh, really?
I amassed about 1,500 of them over the week here as I completely sold off my entire portfolio of stocks and got into the teddy bear racket.
Nice.
That actually didn't happen.
No.
That didn't happen.
I don't think it did.
No. I had a little bit of levity in
You
there.
do seem like a teddy bear kind of guy.
I am a teddy bear myself, but I didn't get into teddy bears that deep when I thought about it.
You did?
It was on the
Was it like deep thought?
It was deep thought.
Yeah.
It was in meditative
Oh,
thought.
really?
Yeah, this wasn't just any
like a
kind
vision?
of thought. Almost a premonition of where my life was supposed to be, which was apparently surrounded by a
rainbows and
teddy bears.
Teddy bears.
Hordes of teddy bears.
Hordes. I thought you said hornets there for a second.
No hornets. No, absolutely not.
I was like, that's horrible.
How was your week?
Good.
You didn't get into the teddy bear racket at all.
No.
You're surviving this cast, though.
I am.
I've seen you at the gym, but you're
yes.
injured today now because
I did heavy legs yesterday.
you overexerted yourself.
I did.
Because you're a silly noob.
Yes.
And
shame on me.
yeah,
Shame on
ego
me.
lifting.
Little bit maybe. It felt good during it, and then
Yeah,
during
not good
last
today
night,
though.
No,
eh?
not good today,
sir.
No.
Not at the gym this morning.
No, I did. I skipped out.
No. My week was good. Thanks
Yes.
for asking.
I was just about to get into that, but
Everything's going perfectly swimmingly. The weather's getting better, despite the fact we had a little bit of snow. I was supposed to go to a concert on Saturday with a dear friend. With a dear friend of mine. I was supposed to go to a concert in Calgary. Have you ever heard of the city of Calgary?
yes, I have.
I was gonna take you there.
I got the inclination that I'm not the dear friend because I was
No,
like,
you
we
are.
were, and
You
then
are.
like dear friend. I was like, what?
I was just trying to tell the story. Right?
Oh,
It was
okay.
a little campfire tale here for the people.
Sorry for interrupting.
Yeah, so I was going to take you to Calgary,
You
and
were?
we were going to see a concert. Another friend of mine in a band that was playing, but unfortunately, a little bit of snow derailed that plan.
Yes, it did.
But it's beautiful now on Sunday.
Now, yeah.
Beautiful
Blue
out.
sky,
So
snow's melting.
I think we're out of the woods. This winter could be over. That's really the only thing that's been hanging me up. Other than that, I'm living the bloody dream over here, homie. Things are doing excellent. So you had a good week. I had a good
I
week.
did.
Triceps been a little overworked out.
Yes.
We're gonna let you run. What is this? 19?
Yes,
This is
19.
19. This is actually 20 because we don't count.
Technically 10.5.
We don't count 10.5,
But
but
that's 20 weeks in a row, though.
good for us.
Good for
We're
us.
doing a good job, I think.
think we
I'm
are,
having a
yes.
good time talking to you.
Me
so
too,
it's
yeah.
interesting talking about this with you. Like usual, like I was saying, I'm going to let you lead. I'm Cody from Wall Street Breakdown.
I'm Anthony from Wall Street Breakdown.
Sir, the floor is yours.
Why, thank you. The markets have been kind of up and down this week, and we've kind of been talking about that this past week and how the markets are kind of
Yeah, well, I mean,
fluctuate,
a
right?
month now, right? We've been told. I think since we had that sell-off on that Friday, that's 4 weeks ago now, I was saying that I kind of thought the market had kind of reached a bit of a top. There really wasn't. We're at such historical PEs through all sectors. I couldn't imagine things continuing to push forward, even with the EPS growth EPS growth that's being priced in for 2018 here with the tax cuts. I just didn't see the markets continuing to surge high, and we see that with earnings even this week. Like if you and there's been good earnings. Like, and I'll get into all that as we get into earnings. I'll get into some statistics. And to kind of contrast and show you how the market isn't even satisfied at this point with like good earnings. You really have to blow it out of the water because everybody's really trepidatious about where we sit. So we had the first down month in 8 months for the NASDAQ, the first down month in 10 months for the Dow and the S&P. So these were down months in February. Finally, a little bit came off, and we have to expect that. You're going to get a little bit of a pullback when everybody is at historical highs. There's so many companies inside of entire sectors that are trading at 52-week highs or right around that range. It just gets a little too overblown. And regardless, economy's doing well, the companies are doing well. I think what happened was, and we've discussed this before, is that over a period of time, things got so hot so fast that we priced in a lot of earnings from the future into the current price. And it's not that these companies are overvalued. It's just that those earnings haven't come to roost yet on an even farther timeline scale than we're used to setting forth for the price of companies. Normally, we're setting it out there for however long it happens to be that that a marketplace is comfortable with it. But in this case, it seems like in every sector, with almost every company that seems to be growing in the right direction, because the U.S. is growing in the right direction, we got way out in front of ourselves and started pricing in growth that's years down the road.
All these high months, right?
Exactly. And things have been great. And the earnings this week, companies got hit. Like a bunch of companies got hit and took money off their share price this week off of good EPS and rev beats.
That's right. Yeah.
You know, like, so I mean, it just wasn't. It's not a market right now that's going to accept anything that's, you know, average or kind of good. It's expecting you to be exceptional, and I can understand that because we're near that top now where numbers across the board start to feel a little puffy. It's a little inflated. We don't want to assume that companies specifically are inflated, but we know the market as a whole has got a little doughy. You know? We've got a little out of shape.
That'd be a good word for it.
Yeah, and we're not as honed in on where the specifics are of who's doing the best. We kind of let everybody kind of reap the rewards of everything going well, and that's good. But there is going to come a process where we start to refine how we separate some of these companies, and there is going to be an adjustment. And I think we're in the midst of that adjustment. So you see it this week. The Dow closes 24,538. The S&P 2691. The NASDAQ 7,257. You see this NASDAQ still above 7,000. I mean, well above it. Not too big a deal, right? But it's still, we're in an adjustment period. There's no question. TSX 15,384. I expect more of the same. I said this a month ago. I expect more. I expect more of the same. I wouldn't be getting all in right now. If you were sitting on the sidelines all cash, this is not the time to like jump into a full diversified portfolio.
No, I don't.
Because I would say a good majority of those S&P sectors are a little doughy. It's hard to say that anybody's overpriced individually, but I just think we haven't really broke it all down and decided who's the winners and the losers. Everything's been a winner. The economy, the populace, everybody's been winning. So we've been letting everybody win. It's time to start separating first place from orange slice again. And that's going to end it's going to end up taking place over the course of a top. And we're at that top now with no sign of economic stuff dragging us back down. But there needs to be some disparity between the best and the also-rans.
Oh, for sure, yeah. Let's talk a little bit about commodities. Have there been any big changes in that market?
Nothing. Everything's pretty much stable. Gold,
kind of
13.23. What was it? 13.27 last week.
I think so. Yeah.
It's sitting in that spot where gold looks like it should be. I mean, it's totally in that spot. WTI crude down a little bit from last week, 61.25 a barrel. Bitcoin this weekend, as of today, Sunday, 11,324. That was a couple hours ago. Bitcoin and the rest of the cryptocurrencies are doing what they're doing.
So it went up a little bit, didn't it?
It went up a little bit from last week. Oil down a little bit. Cobalt is the thing. You know, cobalt.
Yes, I heard about this.
Cobalt is the thing that people are. The cobalt market has gone up so significantly, and cobalt's tied to like copper mining, copper and nickel mining.
Yeah.
So if copper and nickel mining aren't running at a high rate, you're not going to get cobalt out of it because they're completely associated with one another. But cobalt is used in a whole bunch of electronics products and stuff. So cobalt is being used on an exponential level to the point where they think there's going to be a really, really big cobalt shortage coming up for a lot of the people that use cobalt. And like I said, it's used for, like phones and all sorts of things.
It's in a lot of stuff.
It's in
everything.
Everything, it seems like. You know, when I really took a look at it, and there's a reason that the price went up. I think it's like almost 40% in a year or something. It's significant run for a commodity, because it's directly correlated to copper mining. So if copper mining isn't running, and copper is in one of those spots where it's not really too fiscal to have all your equipment going at one good cobalt supply. So now that it's directly correlated like that, and people are starting to feel the tightness on the cobalt supply line, you're getting that price running up, and people starting to talk about that. So from a commodity standpoint, Gold, and I mean, I know oil was a big topic a few weeks ago as it's really broke through 60
That's right,
and has sat there now. But cobalt seems to be the thing that in the last year has been a bit of a sleeper and is now people are starting to
Kind of just
actually.
creeped up.
There's getting to be some murmurs in the marketplace. So if you're a commodities guy, which if you're buying commodities contracts, cobalt out there.
Cobalt, right?
Apparently, right? Do your copper and nickel mining research though, because again, totally correlated to the same companies that are pulling copper and nickel out of the earth.
So we had a lot of U.S. economic data this week. Why don't you give me some of the highlights?
Some of the highlights.
Or all the highlights.
I'll give you all the highlights. So let's start with some general federal data. So U.S. January trade deficit, so that's the lack of money that we've got to pay for the things that we want, was up 3%. So that jumped over estimates, higher than obviously December, up to $74.4 billion in deficit. So the government, every month, the U.S. government is more and more it's costing them that they don't have to be able to do what they're doing, right? So there obviously needs to be some budgetary adjustments that go on.
I agree.
When those ever go on, it almost seems like it goes on infinitely, and there never seems to actually be these checks and balances at this level. I'm always surprised by that. I can never really tell at what point in time is that Illuminati. We talked.
Oh yeah, we did.
Maybe that's the Illuminati part. Is the part where the trade deficit can be so, and just the overall federal debt can be so egregious and grow at such an exponential rate, and still no repercussion of any sort.
None.
Nobody suffers blowback.
Slaps their hand and stop spending.
Yeah. So U.S. trade deficit up 3%, $74.4 billion. Illuminati. GDP forecast falls again. Do you remember when GDP now had the forecast at like 5%?
Yes,
we were talking like 5%, and then they lowered it to 3.2. They've dropped it now to 2.6. So that's like cut in half. So GDP growth in the U.S. still decent GDP growth when you compare it to where we are, and we'll get to that a little bit. But GDP growth 2.6 expected for fiscal year 2018, much, much lower than the 5% that was being forecasted about a month back. Jobless claims in the United States, initial claims down 10,000. Excellent number. You love to see that at 210,000 initial claims. That beat the estimate of 230,000 claims. So down great. Initial claims is huge because that's obviously people that are just back into that job market that just got let go of a job. You know, like continuous claims is ones where you see people. A lot of the times you can have maybe some people dragging their feet in the continuous claims market. Maybe they don't really want to go back to work because government subsidies are good enough at the moment for whatever their situation happens to be. But initial claims is people that are they're looking for a job right now. That's a lot of times they just got laid off, right? So initial claims down, economy again strong. Continuous claims up 57,000 to 1.931 million versus 1.874 million estimate. So that estimate was off quite a bit. So the continuous claims really beat the estimate by a lot, which is not a good thing. But again, economy doing well, initial jobless claims down, trade deficit, GDP forecast falling, not great. Personal income, though, across the United States, up 0.4%. So personal income in January is growing, and that beat the estimate of 0.3%. So personal income is growing. So across the board, there's getting to be more competition in the job market, obviously, and people are paying more for more skill at more different positions because we're growing at a 0.3% estimate already. We beat it by the 1%. So that's what we're or the 0.1%. That's what we're looking for. Is we're looking to get to that point in inflation where not only are prices going up, but competition for jobs are going up and forcing employers to pay more for more skill. You want people to have the option to go to different places and get paid really well for that. And we're getting to that spot. But with that comes, of course, inflation. Unfortunately,
of course.
There's going to be all this stuff. There's going to be a big adjustment period where you're going to see interest rates rise and all that stuff's going to come with it. But ultimately, the United States is in the economic position right now to get over that hurdle. That's a difficult hurdle coming out of what they're coming out of 10 years ago. And we'll get off on a little thing here. People didn't agree with quantitative easing when it happened. Obviously, in the rearview mirror now, quantitative easing was the right plan. We've seen a couple of rounds of quantitative easing. It brought the economy back slowly, gradually, made sure there was money in the monetary system, allowed lending, small businesses to grow. Everything flourished on the right level. Now the economy is stable. We understand that inflation needs to go up. We also understand that there's a need, an absolute need for interest rate increases. But on top of that, we seem to have a government in play that wants to help entrepreneurship and help the actual U.S. economy grow by not stifling it and allowing, I don't know, world trade policies to dictate what should be best for your fiscal policies inside your own federal government. Yeah. And I like that.
Me too.
So with all that being said, you're then going to see things like inflation have to be accepted. You're going to have to just embrace it and be like,
just the way of life.
Things are going to cost more money, but somebody's going to pay me more if I'm a good, well-educated, hard worker, you know, like, so it's a great time to get over that hurdle for the United States because they're back. They gradually brought themselves back. And this is now the task is to get interest rates back to normal, inflation back to normal, and then sustain solid unemployment numbers, solid job growth numbers. That's where we need to get to. So the gravy is done. We believe in the economy. We just need to see the economy be able to implement all those things without any of the historical easing in the interest rate side that we've seen, right? So moving on, some manufacturing numbers. The ISM Manufacturing Index, 60.8 versus the estimate of 58.6. This is one of the big manufacturing indexes, basically just telling you, new orders that are coming in, backlogs, the amount of inventory companies are carrying, orders, all that stuff, right? All the stuff in the manufacturing sector, ISM being the big one. It's at its highest. So manufacturing is up. Booming. It's at its highest since May of 2004. The U.S. PMI Manufacturing Index just missed estimates at 55.3 versus 55.7. Texas manufacturing activity for February production, 27.9 versus 16.8 prior. Capacity utilization, 19.6 versus 14.5 earlier. New orders, 25.3 versus 25.5. So when you look across a lot of the manufacturing data that's out there, it seems like across the entire country, the United States is having a manufacturing resurgence. Things are busy. Everybody's got factories. Chimneys are smoking. There's people running OT shifts. It's night shift, day shift. It's working, and that's good because
that is really good.
When we talk about some of the headlines where we're talking about tariffs on imports, that's what we're talking about ultimately is driving American industry. American industry already driving itself really, really well. Chain store sales up 3.3% year over year versus 3.8% last week. I guess we could talk about homes. We got a lot of home statistics.
Yes, we do.
Do you like living in a home, or would you prefer living on the streets?
A palace.
A palace.
Yes.
So you're not under a bridge dweller.
No.
Not by any means. You could meet some interesting people probably under a bridge, though. Wouldn't you say?
Yeah, you'll definitely hear some good tales.
You got those polka dot satchels on the stick over their shoulder. A lot of good tales. A lot of
good beans.
Toothless good tales.
Toothless good
Absolutely.
Tales, yes.
So people who like homes and like to follow the economy know that homes and all sorts of home statistics are a very good barometer of how the economy is doing at a bunch of different stages. We got a bunch of different housing data this week in the United States. Let's go over a little bit. Bring it. I like this attitude. January new home sales, 593,000 versus 640,000 estimates. So they missed that estimate.
A little bit.
Yeah, new home sales missed the estimate 50 grand almost.
Yeah.
It's a pretty big miss. Case-Shiller housing price index. Try saying that. Housing price index for U.S. was up 6.3% from 2016, the end of 2016. So pretty significant increase in the housing price index.
There you go.
As I get that tongue twister out of the way. January pending home sales down 4.7%. So again, new home sales in January down, pending home sales in January down. December housing price index up 0.3%. So the cost of housing continues to go up as the Case-Shiller housing price index so blatantly showed us, and then the December housing price index shows us as well. Mortgage applications, as opposed to last week where it was down across the board, composite index up 2.7%, purchase index up 6%. The 30-year remains stable at 4.64% for a lending rate. That's probably going to help the housing market as a whole.
Oh yeah.
In the U.S. with the interest rate it needs to find. I mean, home builders have been taking a beating. I mean, we've seen it on the NBA mortgage apps, right? Like it's just slowing everything down. But we understand that was going to happen, and we understand. I bet you there's more people got in when things were right, and it was much more palatable to buy a house 3 months ago, 6 months ago.
For sure.
And now there's a bit of a cooling off period as we go through, adjustment, interest rate, mortgage rate. There's adjustments.
Well, we can kind of understand why house sales were down kind of in January with all the Christmas debt and stuff like that. I don't think anybody has the time to.
Interest rates are up in Canada, and housing sales in Vancouver, another very, very hot market up here in Canada for real estate.
That's true.
Down as well, down 14%. Biggest drop in 10 years for Vancouver. Stricter mortgage lending rules out there in Canada, and interest rate increases that we've seen have dropped off what is otherwise a red hot real estate.
Oh yeah.
Yeah.
Oh yeah.
Vancouver and Toronto last year. I mean, Toronto was on another level, absolutely. With Vancouver, couldn't even see what they were doing, but Vancouver's still above everybody else, including Montreal. Is a red hot real estate market. This year, seeing some cooling off as well, as interest rates and mortgage rates tend to make people somewhat trepidate. A lot of people got in, and there's going to be a balancing out period. It's not like Vancouver or a lot of the major metropolitan locations in the United States are going to have a tough time finding buyers for the right homes there.
Right, yeah.
The economies are still doing pretty well. Canadian GDP growth of 1.7%. So we're talking about GDP growth in the United States, presuming to be about 2.5%. GDP growth in Canada was 1.7%. That missed the estimate of 2%. That's not very good.
No.
A lot of people were saying when I was reading the breakdown of this was that Canada is not even living up to what their growth potential should be on the very bottom end.
Really?
That Canada is really a laggard out of the major G1 countries.
Why do you think that is? Why do you think we're
I think we've talked about it. I think we just don't have the diversification of industry.
Yeah,
right?
I do agree with that.
It's a lack of diversification of industry that I think drives this more than not. And when Canada can't get their they can't get their house in order, and they can't seem to figure it out, and we're so heavy energy, financials, oil and gas, and we don't have any tech, and we just don't drive industry on. There's no sector. Canada's even in the running for a world leader company.
Right.
Let alone are we talking about them doing that in multiple sectors.
It's pretty bad.
It's just, and given the proximity of the United States and the trading that we have with the United States, just the open exchange.
Yeah, that's right.
It seems like it would be almost a natural fit that we would fall into a much higher spot on the food chain. We just don't seem to be aggressive enough maybe to go out and take it. Maybe. I don't know what it is here in Canada, though. We just don't seem to. So we suffer from lack of GDP growth, and then people kind of, analysts looking at it and sort of laughing at our stagnation because we're really growing in comparison to the rest of like Western Europe and the United States poorly.
Yeah, that's unfortunate to hear that, but I guess that wraps up the markets.
That does wrap up the markets, the Case-Shiller Housing Price Index.
There you go.
Just
let's
just
talk about some
last
of the
time.
bigger news that happened this following week.
The following week.
The
week in the
week.
future.
This
I think this
week.
is the second week in a row you've tried to talk about the future on this show.
I'm trying to slip it in there.
Yeah. Do you know something that I don't know about the future?
No, I would have got the lottery winning.
Oh, okay, okay. Well, I'd hope you'd share those.
Oh, I definitely would.
Okay, so what's going on from the week in the past? The week that the week that passed.
We had a new Federal Reserve Chair, Jerome Powell.
Whoa, you're having a tough time getting this out. New Federal Reserve Chair Jerome Powell,
gave a semi-annual mandatory policy testimony.
Monetary policy testimony. He did do that.
He did do that.
He did do that. So, yeah. So Janet Yellen's out. Jerome Powell's in. We've got the minutes from the last Fed Reserve meeting, obviously, last week. That shook up the markets a little bit. We go into that again as people grill Jerome Powell for a couple hours. And, you know, like, he gives us basically the same speech that we've heard.
Right.
I didn't...
It's kind of like just a generic thing, huh?
I mean, he didn't surprise us with anything.
Right.
That's the one thing that I got out of it. I know the market liked to react. That was the big news this week, and a news that's lacking in, like, actual business headlines. That's part of the thing that really shook the markets up in the middle of the week, was the fact that, you know, you've all of a sudden got a new Fed chair. Everybody's a little concerned about what a new person's going to do. They're not you. You're not Ben Bernanke. You're not Janet Yellen. They're not sure what you're going to do specifically. And then on top of that, we're in the midst of the concern that there's going to be 4 interest rate hikes in 2018, which I think is, at this point in March, early March, is not validatable concern. And I don't think Jerome Powell pushed that agenda at all, even though the market kind of took it that way. And I heard rumblings of people saying they thought that's kind of what he was hinting at. I personally didn't see it. Job market remains strong. Jerome Powell reiterated that. Consumer spending, the same thing, reiterated that. They're obviously looking for that 2% inflation number or a little bit higher. Just some normalization of the marketplaces. That's kind of a concern, is to get to a normalization. So inflation's at about 1.7, 1.8. Need that normalization around 2. Are there interest rate hikes on the horizon? Absolutely. Is the economy as a whole, the stock market and everything else, including the unemployment numbers and everything, the actual growth in your income, everything's being monitored at a very close level, which is what the Fed always says before any decisions are going to be made. So to insinuate that there's 4 specifically on the horizon, when we've already been insinuating since the last rate hike last year that there was going to be 3 this year, why don't we just all resolve to the fact that there is going to be interest rate hikes in the future? But to presume that we know what's going to happen and to act erratically seems ridiculous. Like, he came out and said basically the exact agenda you'd assume he was going to say. It was exactly verbatim what I was expecting. Nothing was really revealed. There was no, you know, up his sleeve, rabbit under the hat. None of that nonsense. He came out and toed the company line. The Fed's paying attention. They want to make sure the economy's good before they continue to... I'm telling you, we're already out of the historical lows on interest rates, but we're not out of historical lows, but we're off the bottom. Once we move off these historical lows, once we get, and that we're already moving north on the numbers, that we'll never go back there again. These numbers are not real. You cannot sustain an economy over generations on them.
Right.
These interest rates will not take place again. So these guys want to make sure 1 billion% that everything is okay before they take that next step. You don't want to be the guy that was the Fed chair 25 years from now in history books that just had to push your agenda regardless of what the numbers told you. So for the market to overreact, when you know the Fed's been so hands-off, quantitative easing, low interest rates for a decade. What makes you think they're all of a sudden out there just, you know, headhunting?
Yeah.
They're going to go out 4 interest rates. Like, they're just going to, you know, go out and murk the economy. Just try you know, it's not going to happen. It might if the economic numbers are suitable for it. But unless they're suitable, it's not going to happen. Let's take it 1 interest rate hike at a time, because we do know interest rate hikes are coming. Yeah. That's right. That's what we do know.
Okay, I got a good one. Our next topic affects a lot of companies who import steel and aluminum. There's been some tariffs implemented this week.
Well, yeah, it's going to affect a lot of companies that do import. So you've got a lot of car companies that are saying, I know Ford came out and Nissan and said this was going to make things a little bit more expensive for them, because I guess they were buying a lot of their steel and aluminum from much cheaper sources than what you're going to get from inside the U.S. But what you're going to get is you're going to get a lot of productivity out of the steel companies, and a lot of companies inside the U.S. that are using these companies are going to help to bustle up the economy internally because you're
Right.
you're being curtailed obviously away from importing your steel and your aluminum from elsewhere, so from China per se. But it's going to make the capacity and the amount of availability scarce on the export end too, because like I've heard that like Canada gets about 16% of their steel from the United States and Brazil gets about 13%. They're the two most affected countries that are actually going to have less to be able to import into their country because there'll be less American exports available.
So are these tariffs going to affect these companies like in a big way, or is it just going
Well, definitely, if you're using stuff at a cheaper price point and you're being now, the price point is now maybe will be different by a few percentage as opposed to 18%, you might be a lot more inclined to use an American company because it could probably be there quicker and maybe the relations with that company could be a lot more valuable down the road or whatever it ends up being. You might pay that little premium,
and
right?
plus it helps your economy, right?
And well, I don't know if a company thinks that way.
No, they think with their
I don't know if Ford's necessarily worried about their economy as much as their bottom line and their shareholders, but you could build a lot of goodwill with companies maybe you haven't done business with in a while because it's been cheaper to bring stuff in from overseas. And I get that people, they start to worry about a trade war because like Europe was down quite a bit. Like almost all sectors over in Europe were down at the end of the week because they're concerned with this trade war that's potentially going to go on. China said they don't want any kind of trade war with the United States. And Canada's come out and said that they think these steel tariffs and aluminum tariffs are, like uncalled for or whatever. But Trump is trying to make his own country self-sustaining.
Great again.
You know what? I don't disagree with what's going on.
No,
I think when somebody's got some ideas, they might be a little off base for what we're used to, but that doesn't necessarily mean they're wrong. You can implement something, see how things work, and if things don't work, you can unwind it.
For sure you can.
Things aren't in stone.
It's not forever,
Things aren't in stone. People have to be a lot more flexible. It's a lot like the infrastructure plan that he's got, where he wants people to get things done in 2 years as opposed to 10 years of red tape. Because we don't need all this legislation and stuff. So let's try some things. Let's try some things.
It never hurts to try, right?
So AK Steel and US Steel and all these companies, Alcoa, they're going to benefit quite a bit because they're going to have a lot more demand for their stuff, especially from within their American borders. And some companies are going to pay a little bit more for stuff, but it's going to drive up the American economy. Ultimately, what it's going to do in the complete feedback loop of it all is supposed to drive the production, the manufacturing, and ultimately the hiring of these companies that need this, and all the companies on the front lines that are getting all the resources that are used to make steel and aluminum.
Right.
So there's a lot of work to be done. I think it's beneficial, but did the stock market like it? No, they don't.
No.
They don't like it.
They hate it.
They don't like it. They get very jarred by policy. They don't like when the Fed chair talks. It doesn't matter what he says. Like, he never threatened to ninja chop one guy.
But that's what they hear.
But they respond like he threatened to ninja chop every guy.
Yeah.
Like, they need to relax. Like, just the market's at a top, and it's bipolar is shining through. It just has that about it. You can't rely too much emotionally on what the market's going to do because
I don't think
it doesn't know what it likes. It doesn't like anything and it likes everything all at the same time.
Intrigue.
Kind of embrace it, right?
Just embrace it. Here's a good one. Banks are looking to have the Volcker, correct me if I said that wrong, rule loosened from what I'm hearing.
Yeah, no, that's right. Volcker rule. So it's Dodd-Frank policy. Volcker rule is basically they didn't want big banks, especially banks like over $10 billion in assets, to be trading a lot of speculative stuff at their prop desk. So trading their own capital at their proprietary trading desk, trading really short or speculative stocks. So this rule was implemented into the Dodd-Frank policy that was put into play after we had, obviously, the economic collapse there in 2008, right? So what the Volcker rule, they're trying to get is it eased a little bit. So if you make a trade at a bank that's on your prop desk and it's within 60 days of when that trade was put on, you have to explain why to regulators, why that happened. And it also cannot be your money. It has to be money that was a client's money and why that trade then took place.
Right.
Because what they're concerned with is when you have a bank that has a cash, right? Cash over at the proprietary desk, that's still an asset. So when shareholders look at your asset sheet and they see what you've got on your balance sheet, they're going to see that. And then if you're out there speculatively trading, way more risky than what your shareholders would be okay with for an investment that they're invested in, you could cost that bank, in theory, a lot of money. So they don't want them doing anything speculative, because obviously subprime mortgage investments and stuff were relatively speculative when you broke them down. But of course, we all just overlooked that because they were making a bunch of money at the time because the economy was rolling. There wasn't any defaults. All of a sudden, there's defaults. And you look at, you got a bunch of triple B rated mortgages.
Trying to cover the behinds.
And that's ultimately what this is. So you've got banks trying to get them to ease this policy. I don't know if the actual easing is a good idea. You know what? Usually I'm all for capitalism, and I like the banks, and I like the banks being able to do this, and I like how the banks are able to be like they're able to be like a private equity company and an actual bank. They never used to be able to be like that, right? Back up until for a long time, they weren't able to do that. There was complete separation of church and state.
Right.
There were banks that were private equity companies that were just doing, wealth management, and then there were companies that were completely in the retail banking side. So I like that they're allowed to meld that together, but I don't like when they get so loose with it, because I don't know if even with guys like Goldman or JP or anybody that's at the best, and they've got the best guys working their prop desk in the world,
I imagine so.
I still don't know if I want those guys being able to be that loose with the amount of money they could potentially be investing. So as banks push to have this loosened or reformed or whatever, the Volcker rule, man, I think if you don't remember history, you sometimes can be doomed to repeat it.
Right.
And we've gone down the rabbit hole with issues in the past, issues related to banks being over leveraged with investments that aren't what they appear to be on paper. So let's not do it again.
Yeah.
Maybe that's the answer. Is if I'm trepidatious about it, it's probably wrong, because I'm usually a pretty firm capitalist here who just says put your nuts on the table. Like, just do whatever.
Exactly,
just do it, right?
Yeah.
Like, if you think you can make a go of it, go of it. But I don't like that where people are invested as shareholders in a bank, and then a bank at their prop desk uses their own capital to invest in something that they would never let their own broker recommend to a shareholder who had like a medium risk tolerance, right? So we don't want them doing that on their end just because they're a bunch of cowboys at the prop desk, right? Yeah. So that's my issue. Yeah, maybe no reforming of the Volcker rule would be my vote. We'll have to see how it plays out. Banks have a lot of lobbyists, so they could have a lot of pull as far as getting this reformed somehow. And again, this is a Democrat rule. This isn't a Republican rule. Yeah. So we'll see how this gets changed, or if it gets changed.
Do you have any other headlines hidden up your sleeve?
I'm not even wearing sleeves, but there was we got Spotify files a prospectus to list on the NYSE. That's going to be ticker symbol SPOT, SPOT. They're doing kind of a unique sort of an IPO. They have no underwriters. I believe they've hired Goldman Sachs to be kind of a liaison, someone that they can speak to and how, reference as far as this goes, but no actual banks doing the underwriting. The last time there was sales of Spotify shares on the private market, the shares have ranged anywhere from $90 to $132 a share in the private sales. Again, it's obviously going to all be contingent on how many shares end up going public and the amount of shares that are listed. That's all going to be completely relative to that. They are not going to do the dog and pony show of going around to every bank and venture capital, and they're not going to go and do the presentations.
Why not? Do you think they're just too good?
They're gonna live stream it. They're gonna do one. I guess maybe you can replay it. All these banks and everybody will be able to replay it, or what I imagine will be like a big town hall where you'll send reps that'll go and watch this and ask questions for the companies, because obviously it's all these clearinghouses that are going to be buying all this stuff, right? They're going to be getting all these shares to then be on the IPO and then be selling this off out in the secondary market. So they're going to live stream to investors. So there's going to be a live stream pitch, no underwriters. Spotify has a lot of subscribers. This is a company. This is a company that's got all the companies signed, right? Sony, Universal, Warner Brothers.
Oh yeah,
What-
it's in
yeah.
every multimedia machine out there.
They're all signed, all the big labels. So like Spotify is out there, and they're out there in mass competing with
Yes.
Apple Music and all that stuff.
Oh,
Right?
definitely,
But
yeah.
significantly. So unique way to go IPO. And what could the price be? And live stream to the investors.
Right. I'm guessing they're going to take questions there too at the live stream.
Well,
right?
I would imagine. When you're asking
so.
for,
whatever it is, right?
Tens of millions of dollars at a time. Absolutely. Warren Buffett earlier this week talked to CNBC. We heard about Berkshire, obviously, had their yearly report last week, end of last week. They made a grip of money. It was ridiculous, $62 billion or something.
Yeah.
He talked about the GE investment that they got out of. He said he was going to spend all day reading the actual GE conference call there from Monday. Warren Buffett didn't want to say anything poorly about the GE investment. He doesn't feel like he was duped. He said, the former CEO, whose name escapes me at the time, and then Jack Welch, they're friends of his, and he doesn't feel like that he got into GE for any reason other than the fact that it was right for Berkshire Hathaway.
Right.
And he feels like they still ended up doing well enough that it wasn't a failed venture. It just wasn't something you would repeat again. For a guy who's not involved in tech.
Right.
I mean, it used to be forever. Buffett, no tech.
It doesn't seem like the kind of guy you kind of dupe anyways.
No, I wouldn't imagine. No,
I wouldn't imagine.
I wouldn't imagine. No, the people
he couldn't pull the wool over his eyes.
Himself and the people he's surrounded with, I'm sure, a couple of sharp knives.
Oh, I'm sure they are.
Yeah.
Even at their age.
Yeah. So a guy, again, like I was saying, a guy that's not into tech, never buys tech, or that was the idea. That was the whole ambiance of Warren Buffett and Berkshire Hathaway. They don't get into things they don't know.
Understand, yeah.
Apple last year was the stock they bought the most of.
That's right.
In 2017.
Apple was, yeah.
So he said that once he finally gets himself an iPhone, because he doesn't have one yet, even though he owns Apple. He said once he gets himself an iPhone, that Apple can consider the smartphone market 100% saturated.
I think he gets his phone comp to him, like just free of charge. Like they send him one. I imagine so.
You would think so.
I don't think he actually goes and has to pay for his.
You would think so. Yeah. Disney moved the Avengers Infinity War movie. Did you hear about this?
No, I didn't.
Have you seen any previews for this movie?
No, I don't watch TV. So
no, I don't watch TV either. These movies are usually good.
They are. Once I do
movies.
Get around to watch them here and there or something.
I think a couple of these guys are on the last movie of their contract. I think
so.
I think they are. But anyways, it moved it from May 4th to April 27th. That's because May is a busy month for Disney. Now that Disney is taking on, and again, we haven't heard anything else about a competing bid from Comcast in regards to
the
21st Century Fox. They're taking on Fox. Deadpool comes out in May and also does Solo, a Star Wars story.
Yeah.
So that would have made it 3 really big movies associated with Disney, because Deadpool wasn't directly associated. It won't be then yet.
Infinity War comes out April 27th?
April 27th.
So that month, because it's May 27th is the big one, would be the Han Solo one for May anyways.
Yeah.
That month is going to be great for them.
Go, I'm telling you.
That's going to be good month
Well,
for Disney.
I mean, it's always seems to be pretty good holiday and summer seasons for Disney, doesn't it?
Yeah, it does.
There's never really those down seasons where you say, man, Disney product just doesn't seem to move units.
No.
It always seems to be overtly impressive.
Oh, yes.
They have such a good creative department that just has such a breadth of imagination that things always seem to be good. It's a very, very impressive company.
100 years of heritage coming up, so
but it's the 100 years where you'd think Jesus, have you not run out of ideas yet? No. At what point in time do you hit the skids a little bit and Disney
Well, maybe that's why they bought Fox, right?
They're not on the skids though, I don't think.
Or in the bids to buy Fox. I shouldn't say they bought Fox, they haven't bought it yet, but that's probably why though, because they did start off with just cartoons and they kind of moved into the CG world with Pixar and stuff like that. So, who knows?
I think Disney just can't do anything wrong.
I don't think so.
No, made a deal with the devil or something.
I think so. Walt. Oh, definitely.
Yeah, Walt did it.
He's frozen though right now.
Oh, I would imagine so. Just his
I'm
head.
pretty sure he's cryogenically frozen.
Some sort of menacing face on him. Congress is set to vote on Tuesday this coming week on a 5G spectrum auction to speed up the adoption of 5G. Obviously, we're hearing about 5G, AT&T, Verizon, Sprint. Everybody's running trial runs at all sorts of different locations. Super Bowl, Olympics. Here, there, everywhere, the 5G platform is going to have wireless home internet. We know that.
Yep.
And the U.S. government and the FCC are speeding up the process to get this adoption taking place. FCC Chairman Ajit Pai, auctions for 28 gigahertz are going to happen in November, followed shortly after for the auctions for 24 gigahertz spectrum. So this is going to be happening. So these big telecom companies are going to be putting out money. Maybe see some surprises of companies going and trying to get some telecom, some actual spectrum out there. We'll see how this plays out, but we're getting some expedition on this. Good job by the government. Let's get it on the go. These companies got trial runs going now. AT&T and Verizon are going now. T-Mobile is expected to go. I've got T-Mobile's here. Actually, T-Mobile at the Mobile World Conference said they're working with Ericsson and Nokia to build their 5G network. And we heard what the T-Mobile said a couple of weeks ago, where they said they're going to beat the duopoly, meaning AT&T and Verizon, to true 5G. What does that mean?
I have no idea.
I don't know.
But it was a slap in their face.
Yeah.
True 5G.
True 5G, bro.
Right.
You don't have true 5G. We got it over here. Working with Ericsson and Nokia. So they've brought in a bunch of Scandinavians. And with these Scandinavians, we're going to get true 5G or warlocks.
Well, I imagine the warlocks
going to be able to shoot internet out of your eyes.
Yes.
Yeah. So that's going to be rolling out in 30 cities in 2019 from T-Mobile. That was at the Mobile World Conference early this week. So we're getting a lot of 5G news in every week now. 5G news. We're getting a little trickle in from everywhere. Obviously,
the past few weeks,
it's bubbling. It's going to be taking place. So Dallas is going to be T-Mobile's big kicking off point. I think they said they're going to get all of Dallas coverage 5G to kick off 2019. So that's going to be a big one, obviously, there. AT&T, speaking of AT&T, not the telecom side, but the actual corporate side of AT&T. First is the Justice Department in the bid to purchase Time Warner for $85 billion. We are going to have that court case start March 20th. It was supposed to start. No, 19th. It's going to start the 20th. My bad. Going to start the 20th because some of the pre-trial rigmarole hasn't been worked out yet. And apparently between today and March 19th, everybody's too busy to get together. So there's that one day and it's not done. So they're pushing this one extra day, even though there's like a timeline on when this can all be done. And which is in April sometime, is it not? And the judge said there's no way he thought the case was actually even going to get like a resolution by like the time that the actual SEC filing was to get this done. And that's already been extended once to actually have the merger go through, the buyout.
How many lawyers was working on this case again?
I heard the Department of Justice.
This is interesting.
The Department of Justice said that they were working an uphill battle.
Yes.
They said that the Department of Justice legal team of 30 lawyers.
That's a lot.
30.
Right?
Working for the Department of Justice of the United States, right? That's a couple well-educated, well-dressed.
For sure.
Yeah, that's a legal team.
But what does AT&T bring to the table?
And I thought of that, and I was like, that really seems like a large team of litigators.
That's what I thought.
And then they said, in contrast to the AT&T lawyers of 700 or 700. So. 700 lawyers on retainer that are dealing with just this piece of litigation. This isn't all AT&T would be going through at this point.
They're fighting a war, not an uphill battle.
They are. Apparently, AT&T wants to purchase Time Warner.
Apparently.
Because you'd be paying about $1 million a day in lawyers.
Oh, I could imagine. Like minimum.
Right?
Minimum.
Just for this. Just to work on this. They can't wait for March 20th.
I believe in this
that
deal.
One extra day the judge pushed it ahead could send AT&T into foreclosure. Right?
Yeah.
Ridiculous. Comcast we talked about Comcast making a bid to buy 21st Century Fox out from under Disney, but that bid never actually materialized that we saw. But Comcast made a bid to buy Sky assets that have already been agreed to be sold to 21st Century Fox. So kind of a roundabout. Oh, so these were agreed to be sold to 21st Century Fox in December of 2016. These are about 60% of the assets of the Sky network over in Europe.
Not Skynet.
No, not Skynet. The Sky network over in Europe. Very, very big broadcasting over in Europe. So Comcast increased the bid 16% over what 21st Century Fox's bid was. And again, December of 2016. Yeah. We're talking 15 months ago this bid went through. And they're trying to buy Sky out from under that. Obviously, Sky, the assets would have if they would have went to 21st Century Fox, they would have ultimately ended up going to Disney. Right? As it all comes crashing down and Disney ends up owning everything. So this might actually help Disney close this deal in kind of a roundabout way, because
a little bit,
they might push off some assets they don't necessarily really need. And Comcast can take those on, and then Disney has a little less they're taking on, because I'm sure what Disney wants is a lot of the brands. The stuff that they can build parks out of, and
all the intellectual properties.
The Simpsons. How many Simpsons parks are there going to be in the world? You know,
I can imagine just like Disney Worlds, Simpson Worlds. Or
exactly, right? So there'll be Springfields all over the place.
Exactly.
Absolutely. Yes. So Netflix signed a deal to be added to Sky. So we're talking about Sky being purchased by Comcast. They added a deal to be added to Sky across all the European countries that Sky is in. Again, major cable provider over there in Europe. So Netflix is going to be on there. Same kind of pay subscription service. You got to go on and obviously pay for it. It's not going to be free like how they show pay-per-views for free over there. Yeah, you don't pay for the UFC or any of that kind of stuff. Speaking of the UFC, Amazon has started selling UFC pay-per-views. You don't even have to be a Prime. Of course they don't have to be a Prime member or anything. On top of that, Amazon bought video doorbell startup Ring. So it's a company that obviously shows you who's at your door. When the doorbell rings, it'll show you on your phone wherever you're at. It was an undisclosed price. They valued Ring at about $1 billion. Walmart earlier this year tried to buy Ring, and Ring said no dice to whatever Walmart's offer was. So it must have been a pretty decent premium over what they're valued at, I would imagine, for Amazon to get a hold of them. And Amazon must really want one of these video doorbell companies, because in August of 2016, they tried to buy another video doorbell company that it never ended up going through. So Amazon clearly looking to diversify into this market as probably an adoptable feature that'll be added into the smart speaker and Alexa. All of that is probably going to all be intertwined at some point in a future generation of the smart speaker at home, as the speaker will eventually be the complete vehicle for your house. You'll run everything with that speaker, and that speaker will have attachment through all your mobile devices and everything, and you'll be able to do things to your house from 100 miles away by just talking into your phone, and everything will turn on and do this, and absolutely set the mood.
Jetsons is coming.
Set the mood, Alexa. I'm coming home, right?
The mood.
Daddy's coming home, Alexa. So you can only imagine that that's on the precipice. And when you talk about that, Loop Ventures analyst Andrew Murphy was actually talking about Amazon and saying that automated retail, which we see a lot at Walmart and stuff, you go through retail and do it yourself, could be a $50 billion industry in the near future, dominated by a company like Amazon. Now, why would other companies doing retail use another retailer to do their retail through? And it's not just because Amazon is a retailer, but it's because Amazon has basically a full turnkey operation for complete autonomous retailing, where you don't actually have to have anybody there at the point of sale. Between Amazon Go, fulfillment by Amazon, and Amazon's web service, the cloud platform, Amazon can have a complete secure system from start to finish that can allow retailers through the Amazon platform, who probably take a cut then of things, to just use that and completely be hands off and not have. So now you've got Amazon potentially getting into, it almost sounds like the credit business or something, Visa, MasterCard.
I don't know, because like you can just whatever you want from Amazon. Can't you just order it on your phone or tablet?
But I mean, what if you're purchasing a proprietary item? What if you're purchasing something from the Gap, but the Gap has gone in 2 years to all automated retail? Does the Gap want to go out into and build their own like proprietary system to run that, or do you go out into the marketplace? Well, you go into the marketplace, and the company that already has all the equipment, all the systems in place already, happens to be one of the biggest companies in the entire world already. That just happens to be Amazon. So now you have all these other companies 10 years from now on the horizon that have decided to cut costs and limit their amount of, raise their security somehow, but limit their amount of on-site staff and use
these kiosks or whatever.
And now all of a sudden, who's going to be there to take advantage of a potential $50 billion industry? But a company that is in little incremental steps built up this entire turnkey business that they can now all conglomerate together and sell off to other businesses to use and then take a cut.
Because I thought that they're just going to have a Amazon kiosk at the mall where you can just go and order stuff off of Amazon. I didn't know that.
It's the idea of getting into other businesses, right?
Yeah,
getting into the other businesses, getting inside their walls, and being able to let them sell their own proprietary stuff, spend their own advertising money, do all that, and you take 2% off every sale. Right? Just because you're just the middleman that makes everything you just facilitate the sale to take place. Amazon, they're everywhere, absolutely. So inside this analyst breakdown, Andrew Murphy at Loop Ventures, he said voice shopping, and this goes back to the Alexa and how it's going to be tied into everything, including your doorbell as they now purchase this Ring company. Voice shopping is going to be a $40 billion a year industry by 2022. It's only a $2 billion a year industry right now.
That's still pretty good, $2 billion.
But it's going to grow to 40 in the next 4 years. And what company is well out in front in market share for the home speakers? Amazon.
Oh, definitely.
Well ahead of Google. Apple had a late start. The implementation of all the things Amazon has, the link ups with Target and Whole Foods, and I mean, Amazon is well positioned. I know that share price is $1,500 or something, and their PE is terrifying. But when you look at the potential for all the places Amazon could grow into, every week I'm wowed by the new possibility that Amazon could go here or could go there, and never do I see them ever infringing upon any kind of legislative issues where it's like, oh, that's becoming too much of a monopoly.
Right.
They spread out like the plague.
Oh,
they don't really make themselves really hefty in one area. They're
everything.
They're a global company that really just covers it all. And this, when I read this analyst breakdown, I thought this made perfect sense, and I was just going to partner it up with this other Amazon story about the doorbell startup company, because I thought it's obviously hypothetical, but when you think about it in a practical way, it's very tangible, and the implementation is obviously already there.
Oh, for sure.
And companies are moving towards automated retail already. So I thought, it's a great story to pair up just as a thinking piece for people to take a look at. That is it. That's the end of headlines. I have no other headlines. Qualcomm and Broadcom,
of course,
are trying to get together. Have you heard?
I've heard about that.
Did you know that Broadcom wants to purchase Qualcomm?
Oh, that's new news to me.
They had a $70 a share price bid originally. That went up to 80. That went up to 83. That went down to 82 as Qualcomm upped their bid for the NXP semiconductor company, which Broadcom wants them to close that deal already to get this done. In the midst of all that, Broadcom has put up for vote some members for board of director over at Qualcomm for their annual meeting coming up shortly. Now, one of the biggest investors in Qualcomm, Parnassus Endeavor Fund, says they will vote to keep the original board members at Qualcomm. That's in this $142 billion takeover bid from Broadcom to Qualcomm. They're trying to get board of director guys from Broadcom onto that to get that vote to go through to accept that bid. The biggest bid of a takeover in tech history. But when one of the big investors comes out in public, that's a real vote of confidence for the Qualcomm side. Because, I mean, it's a heavyweight now. We're not talking about lightweights. We're talking about some of the guys that are entrenched in this company. They clearly see an upside staying diversified away from whatever Broadcom's doing, regardless of the premium Broadcom's paying. Yeah. And I know we've heard Qualcomm say that they're being undervalued. We're being undervalued, like by Broadcom. Yeah. I don't necessarily think they are, because we've seen the semiconductor industry. It moved last year significantly, and Qualcomm didn't move at all. So undervalued, I don't necessarily see that. Licensing issues, legal issues. It's been nothing but issues at Qualcomm. But This is a big vote of confidence. Parnassus Endeavor Fund, one of the big investors in Qualcomm, says they are not going to be co-signing, greenlighting new Broadcom board of director appointees. They're going to be sticking with the Qualcomm guys. So there you have that. There's your headlines. I knew you couldn't. I didn't have a Verizon story because I know how Verizon really just tickles your fancy.
They do.
But I knew Broadcom and Qualcomm. They're doing a real a dance between the two of them
for such a long time.
Oh,
this is such a long dance.
It actually hasn't been that long, but it feels so dragged out.
Well, yeah, I think that's a better term. Dragged out.
It's the young and the restless between these two.
Definitely soap opera. Definitely. Anyways, on to earnings. We have a ton of earnings. Well, not really a ton, but we got a few earnings to go through.
Okay.
Give it to
earnings.
Me. Earnings.
Earnings is done. 97% of the S&P 500 have reported their earnings for this quarter. So hallelujah.
Thank you.
Hallelujah, Jesus. We are going to get somewhat
of
a break, at least on the earnings end of things, as we'll get ramped up but hopefully the headlines pick up.
Hopefully.
We've been a little scarce with really good economic headlines. There's lots of economic news, not a lot of business news.
Yes, that's very true.
It'd be nice
There's a lot of news in the markets, but not really
something to sink your teeth into.
Yes.
But as we talk about 97% of the S&P 500 reported, 74% of that 97%, so a very, very large margin, reported positive EPS numbers. So don't start assuming that just because we're near a top, even though the market seems to react negatively even to positive EPS numbers, and that happened this week a couple of times, which, I mean, that can happen, right? Underlying fundamentals can definitely be a lot more glaring than you just beating EPS by a couple of cents. But just on an overall, when you look at it, 74% of reporting companies beating EPS to the upside. Come on, you got to like that.
No doubt.
Fitbit makes the little doodad that tells you your blood pressure and tells you how many steps you took. You know what I'm talking about?
Yep.
You got one of those?
No, I do not have one of those.
How come?
I don't know. That's a good question.
Do you have something that works like a Fitbit?
Oh, yeah, I do myself on my Samsung phone.
Oh, okay. Maybe that's why Fitbit probably isn't a good investment.
No, probably
because
not, no.
Between all the different smartwatches that are out there and all the different things that are implemented on people's phones, which they already have in their pocket, you can already have a pedometer.
Exactly.
And a thing that can tell you.
I thought you were asking me if I actually had a Fitbit.
No, I knew the answer. It was
yeah.
I
have something of the sorts.
I was being facetious.
You were.
Yeah. So anyways, Fitbit traded at the start of the week at $5.50, around that range, dropped down to $4.97 after it reported earnings. That's to close the week. Negative 2 cents a share, missed by 2 cents. It was supposed to be a break even. Revenue of $570 million, missed by $18 million. That's down 0.5% year over year. They were down 11% in after-hours trading after reporting on Monday. So people were not too impressed with the actual earnings call. Double-digit revenue declines in the United States, down 13.4%. They did sell 5.4 million wearables in the quarter. The average selling price has gone up 20% to $102 a device. They have no debt at Fitbit, so I like that when I looked into it. $2.87 of cash per share, but they lowered their guidance for the following year and expect limited revenue from new product introductions. So it doesn't sound like lots in the pipeline for a company that's not already growing and kind of stagnant. And you see this double-digit revenue decline in the United States despite the actual selling price going up 20%. You start to wonder if this isn't maybe just GoPro again.
What else how can you make a Fitbit better? It just counts like how many steps you take, how many calories.
So I mean, it was a nice little cute idea when it comes out, but a lot like other things, it just gets integrated into other items we're carrying with us no matter what.
All the time, no matter what you have your cell phone.
My cell phone is my bank.
You take it to your bathroom everywhere, right?
Yes, absolutely.
So if you want a Fitbit or something of the sort.
So and then on top of that, there's some of the digital watches obviously take quite a bit of the market share because while Fitbit is probably very nice, there's a little more of a prestige to have a much higher brand name. The Fitbit is much more associated with exercise, whereas the Apple would be a lot more associated with just still style.
Yeah, luxury kind of thing.
It really would. So
Yeah.
Fitbit has a bit of an uphill battle there too, being stigmatized as exercise wear that can be replicated on your phone or
sure,
through your
yeah,
smartwatch made by somebody else.
Yeah.
Toll Brothers Home Builders, 83 cents a share versus a 61 cent a share estimate. That is pretty damn good. 1.18 billion in revenue was in line, up 28.2% year over year. Home builders have been having an outstanding last couple of years.
They have been.
As like we said, home prices have gone up, new home sales up. Obviously last month we didn't get that, but consistently up recently. Now as the 30-year rate starts to come up, obviously these companies are going to get some significant impact from that. I think Toll Brothers still, when I look at their numbers, still have room to run over $50. They were at $48 when earnings came in. They closed the week at $43.91. I look at a lot of these numbers and think that Toll Brothers probably should be over 50. This I thought was a bit of a steal. I looked at this and thought this went on a list immediately of things I had to do more work on because it just had too many good signs where I was like, this just seems a little oversold at this point, all in relation to the mortgage rate, right? Like, so you let this kind of find a bottom, and once it starts to adjust itself a little bit and starts to test resistance going up again, I think you might find yourself in a pretty good spot to buy this. But that's for you and your financial advisor to deal with. But contracts in dollars up 36%. And they average 24 sales per community, so per houses in a community that they're building, versus last year where they were averaging 19 houses sold a year in a community. So up quite a bit there. California was up 93%. Their western region up 36%. The south up 17%. The north up 15% in sales. The mid-Atlantic, the only area that was down just a nominal amount.
Are Toll Brothers located in California? That's where I was like, California.
No, a lot of growth there. Toll Brothers.
Oh, okay.
Toll Brothers, I believe, are located in the south.
Maybe,
Yeah, not maybe. We'll have to.
I'll look that up.
We'll look into that absolutely.
Just because you said California, so I thought they might have.
No, 93% they're up there is quite a bit of growth in California. U.S. new homes getting a 30% premium, Toll Brothers says, versus used homes, and they've stabilized. All their stabilized rental apartments out there are already 95% leased. So Toll Brothers obviously not only just in homes and home sales, but building rental units and maintaining those and leasing them out or renting them out. So their rental units 95% leased out. They've got 14,000 rental units in the pipeline to be built here in the next little bit that have already been zoned, already been greenlit. Yeah, so Toll Brothers has a lot of stuff going on I was surprised when I took a look at just sales overall and sales per individual community. Like, it wasn't just that they were expanding at this ridiculous rate. It was that even in communities that are small, the averages of homes inside each community were just going up, which just says sales of homes in total, like we've seen in the numbers, continue to go up. And you're going to see, they're from Horsham, Pennsylvania, my friend. So maybe they're the Pennsylvania Dutch.
Is that like Midwest?
The Pennsylvania is over just off of the state of New York. Okay. It's in the east, not on the coast, but it's not far off the coast. So I'm not sure what you'd consider it regionally. The tri-state area potentially is what it's called.
Yeah, okay.
Potentially. I don't know my U.S. geographical terms. Lingo. No, I haven't done a lot of interstate riding. On that. Yeah, but Toll Brothers, regardless of where they're from, the growth is there. That's what we want to see. And the growth is there across so many different aspects of their actual business. And when you take a look at the number that they're trading at in relation to like their PE and the sector's PE averages, I thought Toll Brothers was a pretty good thing to actually go back, take a second look at. Up here in Canada, banks continue to report earnings. Bank of Nova Scotia, $1.74 EPS, beat the street by 6 cents. $7.09 billion, beat the street by 80 million. That number is up 3.2% in revenue year over year. Bank of Nova Scotia reported earnings around 62.70 and closed the week at 61.22 as they cut back a little bit of that stock price. Return on equity of 16.2% versus 14.3% last year, so the ROE is going up. That's good. Canadian banking up 12%, international banking up 16%. They raised the dividend from 82 cents from 79 cents. So the Bank of Nova Scotia is doing all right.
Yeah.
It seems like Canadian financials are doing so well and have been up so much with revenue gains quarter over quarter over quarter. Every financial institution up here, we're growing Canadian, American, everywhere basically, but at the trading desks because there just isn't that much trading going on. And people just they're done responding to it. Like the bank went down. Those were all good numbers. Double-digit growth in Canada and international. And it went down. Like we've reached that level where we're just not impressed.
Yeah.
Because prices are just that high. Like we've run it up. We understand things are good, but there is literally another glass ceiling we have to break through across, it seems like almost predominantly the entire market, before we really start accepting good earnings as being justifiable for a price hike again, because good earnings knock the price down. Bank of Montreal, $2.12, beat the street by 6 cents. Now, that EPS number is down 7% year over year, but they sold Monterus last year, and that is affecting that EPS number, is just having that company obviously not there making that money. $5.68 billion, that beat by $230 million, and the revenue number, despite Monterus not being there, was up 5%. So Canadian private and public and commercial banking, private and commercial banking, whatever they call it, personal and commercial banking, P&C is what I've got written as my acronym, down 13%. Again, Monterus sale takes that down. In reality, without that being involved, if you take out what Monterus had to begin with, it was an up number. In U.S., up 23%. Wealth management, capital markets, both down nominally from last year, but beat on EPS, beat on revs, 78.40, dropped to 74.90 by the end of the week. So you got a $4 price drop when the company actually reported what I thought was at least earnings relevant enough to keep your price stable, not to take 8% off it, you know. But apparently the market doesn't see it that way. We're just at those spots, unfortunately, earnings wise. Let's do the last Canadian bank of the week.
Okay.
TD reported earnings $1.56, beat the street by 10 cents. $9.36 billion, beat by $400 million. That revenue number up 2.6% year over year. The dividend from 60 cents up to 67. Return on equity 16.6% versus 14.5% last year. Canadian retail banking net income up 12%. U.S. retail banking net income up 19%. TD Ameritrade net income up 23%. Wholesale banking net income up 4%. Beat on EPS, beat on revs, up double digits in everything except wholesale banking, but everything across the board up. 58.50 when they reported, 57.89 to close the week, down on what is amazingly good earnings.
That is.
Yeah.
That is. That's really good earnings.
At least the trend is stable, that good earnings gets you nothing.
Yeah.
You receive nothing for this.
Never.
You were going down regardless.
Yes.
If you would have reported bad, you'd have took a 15% hit. You reported good, you took a 4% hit.
Yeah.
You know? So at least they're fair. They're being
I
fair.
guess so, yeah.
Everybody gets their hand slapped regardless of how well they did.
Yeah.
It's just depending on how bad you did is how hard you get it slapped.
Right.
But you're getting it slapped.
Good. Yeah.
Everybody's taking a bit of a drawdown.
That was good earnings.
That was good earnings.
Those are really good earnings.
Taking a little off the table. They're not happy. They're not happy out there. Express Scripts, they're selling you Medicare plans. They're selling you prescriptions, mailing you that stuff through the mail. $2.16 EPS. Beat the street by 7 cents. $25.4 billion in revenue. So obviously selling quite a bit of pharmaceuticals. Beat the street by $290 million, up 2.2% year over year. They were around $78. They found themselves down at 74, 77 to close the week. Again, beat on earnings, beat on revs. Rev number jumps year over year. still down. Claims were flat year over year. Employee bonuses, though, because they've got some extra money, depending on tenure, $500 to $2,000. Spending on specialty drugs were 41% of total spending, and that number was up 11%. So, spending on specialty drugs is 41% of the total money spent on drugs, and the number was up 11% for the actual cost. So they're gaining a lot of money here. I don't know why they took such a beatdown other than claims flat. Might have been the thing that really 1.5% is their drug trend versus a 2.1% last year. So that's the price increase in actual drugs. So it's down overall and down against the marketplace. So, I mean, there's actual 44%, well, it's not down overall, 1.5% across the board, but 44% of clients had negative trend and paid less in 2017 for drugs than they paid in 2016. So not only are they able to gain more rev, gain more EPS, up the price of the specialty drugs, despite them being the highest sellers, overall, they've got a lower drug trend than most people that are actually supplying drugs out there at 1.5% growth.
Right.
And 44% of clients actually got cheaper drugs last year than they did 2 years ago. So Express Scripts, clearly, able to cut some pricing, able to grow, and still no response from the market.
No, none.
Totally got snipped.
They got their hat slapped there.
Big time. There's slaps all around.
You got good earnings slap.
Yeah, everybody's just getting, backhands.
Backhands all around.
Square. They're getting in on this Bitcoin deal, right? We've talked about Square. I've had a Square for my phone. It works really well, actually. 8 cents. Beat the street by 1 cent, $616 million of revenue. Beat the street by $14.37 million. That number up 36.3% in revenue year over year as Square continues to grow. 4602 basically unchanged from the actual earnings. 7 million monthly active users, not many. That's not many. There is a lot of room to grow there. Are they going to be able to grow? Because they've been around a long time. What I was thinking when I was doing this was, is there just not a marketplace for this? Like, is the point of sale just not as important where everybody else has their point of sale stuff fixed into some hardware in their store? Like, the reason we had it was because we were somewhat on the move.
Yes,
we needed it because we were mobile and needed to be able to, we weren't selling, we weren't on mobile like that.
No.
Settle down out there. But we needed it because we didn't have a fixed point of sale machine.
That's right.
But at 7 million users, active users, over how many years Square's been around? And Square offers, I mean, they take all credit cards, debit. It's all easy, really, really easy. I'm wondering if
that's a low,
maybe just the market isn't there. And it's free, right? Square is free. You just sign up and they send it to you. It's not like it costs you anything to jump on board.
Yeah, there's no sign-up fee or anything like that.
So margin in fiscal year 18 expected to be 19% versus 14%. So margins are increasing. I just wonder if it's a matter of the actual implementation. If there's just not enough people that want what Square has to offer, Square branching out into Bitcoin might be their only way to actually get any kind of headway growth. Because I guess everybody's got a fixed business. Everything's tethered through your computer and your internet and all that stuff. Yeah. When you start doing this with a Square, it's done through your cell phone, through your telecom provider. It's different. I don't know. It seems really convenient to me.
It does.
As opposed to having the big bulky machines with all the wires.
Oh, yeah, for sure.
But apparently the growth at 7 million monthly active users just not there at the moment.
No.
Etsy. Do you know what Etsy is?
Etsy. No, I don't.
They're selling like crafts and knickknacks and antiques and all sorts of, you can buy and sell, and it's a smorgasbord of things you don't need. But Etsy is out there, and they're publicly traded, and they had really good earnings this week because crafts. People like crafts. And knickknacks.
Yes,
the knickknack market is huge.
I guess so.
Yeah, you like
apparently it's
making
massive.
your own pegboards or whatever. 15 cents EPS, beat the street by 6 cents. 136.27 million, beat by 3.72 million. Obviously, very small company, but revenue number jumps 23.6% year over year. They were roughly around $21 trading, and because people love crafts, they're trading at $25.71. So a small little company, basically just hustling knickknacks.
Yeah,
doing a good job of it, though. Doing a good job, had their stock price bump, but big multi-billion-dollar financial companies with good, double-digit growth internationally. They got no love.
Yeah, what happened?
Slapped.
What happened?
It's a backwards world we live in.
It is.
Bipolar the market is, I tell you.
Must be.
It needs to be medicated. Not enough pharmaceutical companies reporting earnings.
No.
Giving them those SSRIs.
Yeah.
Need a little bit of calm down. First time over $1 billion in merchandising sales for Etsy in the quarter. That's a growth rate of 17.8%. So they're moving. I mean, they're growing. It's a niche, but it's one of those niches like a Pinterest where there is a very, very active market that like that stuff.
Yes.
Etsy, obviously, and Pinterest almost go hand in hand together.
Say that, yeah.
So, and there's a very niche market for it, but the niche is very large.
Mm-hmm.
So, because there's craft shows and all that everywhere.
Oh yeah,
That stuff
everywhere.
Yes,
everywhere.
but you're not going to catch a lot of you or me at these craft shows. So very niche market.
Yeah,
yes,
very niche.
very much
Very
niche
niche.
market, but a very large niche it is. Lowe's, major competitor to Home Depot, reported earnings 74 cents a share, missed by 13 cents. That's a pretty big miss. $15.49 billion, beat by $160 million in revenue, but that revenue number down 1.8% year over year. So while Amazon or no other internet company is going to be encroaching on Lowe's lumber business anytime soon, because it's very expensive to deliver snow blowers and lumber.
Oh, I can imagine so.
It seems like Lowe's is doing themselves no favors in allowing Home Depot to continue to gain market share that they don't need, as Lowe's withers on the vine. Lowe's doing nothing of sorts that's too remarkable. Comparable store sales up 4.1% versus a 3% estimate. That's good. SG&A costs, that's selling, general, and accounting, 24.28% of sales versus 23.99% last year. So that cost is going up. Cost of sales overall, 66.27% versus 65.59%. Cost of sales overall going up. Gross margin, 33.73% versus 34.41% last year. Gross margins going down, costs going up, margins going down. Lowe's, comparable store sales are picking up, but all these other numbers, very, very shaky ground, I would say, when you consider that Home Depot is destroying things.
Oh
still.
yeah, they're definitely the leader in that market.
Yeah, there is no. I would say Lowe's is number 3, as Home Depot is comfortably number 1, and their aura takes up number 2. Right?
Yeah.
Lowe's could sit in number 3 as far as the home improvement stores go.
Yeah, for sure.
L Brands.
L Brands.
L Brands, do you know what they hold as far as companies in the L Brands umbrella of companies?
Oh,
Victoria's Secret.
That's right.
Pink and Bath and Body Works. So all sorts of very luxurious things at L Brands. $2.11. Beat the street by 6 cents. $4.82 billion in revenue. Beat the street by $100 million. That number up 7.3% year over year. L Brands started their earnings call around the $50 mark, but closed the week at $43.35. L Brands said in their earnings call that they're revamping the panty business at Victoria's Secret. I'm not sure how, but I'm interested to see what they do.
They definitely have my curiosity.
Yeah, I'm always interested to see in any kind of changes in the panty industry.
Yes.
L Brands, you do God's work. Pink is the one that's actually growing. They've got some small sales store growth. Obviously, Bath and Body Works growing, as well as the sales and operating income up 11%. Unfortunately, Victoria's Secret is the one that's having the actual issue driving traffic. Victoria's Secret did say that 40% of their new customers, though, purchase bras. That's what came up. So apparently loyalty, the bra is something maybe very, I don't own a bra personally. So again, this is me.
Yes.
I'm shooting from the hip here. I haven't consulted with my wife about bra purchases. But apparently bras are something that may be difficult to find that fits properly. Right. So Victoria's Secret really showing that they can build some brand loyalty if something that's difficult to buy, to find that fits properly, is one of the first purchases a new customer makes. They clearly have some well-designed products. Unfortunately, the brand, while we do see Victoria's Secrets and Pinks at the malls that we go to, very
We do,
busy,
yes.
the brand might be just a little played out. Victoria's Secret to me, for some reason, still sounds very the 80s.
Yes.
Right?
Yes, yes.
Doesn't it?
Victoria's Secret.
Like there's something about it that just has like an 80s, it's like a
retro
Van Halen
vibe.
sort of a thing. It doesn't come across to me as like luxury unmentionables. It sounds still kind of like trashy.
Yes.
I don't know what it is. But anyway, so L Brands, kind of a mixed bag across their earnings report. Well, definitely wasn't the best earnings call of the week. Wasn't the worst, but still got smashed. Like everybody else got
Yes,
smashed.
of course.
Salesforce.com, 35 cents, beat the street by 1 cent, $2.85 billion, beat by 40 million, up 24.5% year over year in rev growth. Subscription and support revenue up 26%, professional services up 7%. Salesforce.com, finally a company getting a bit of a bump off a good earnings call. $117 roughly they were trading at. Closed the week $121.92. So a fairly nice bump off a good earnings call. It's about time. Anheuser Busch InBev. They make a little bit of liquor. They are heavy duty in the liquor. $1.04 beat the street by 5 cents. 14.6 billion, beat the street by 110 million, and that number continues to grow even for a company so entrenched in the marketplace. Now again, they did add on another company last year, so you're going to get a bit of rev growth out of that, but that rev number up 2.8% year over year. $109.50 to start the earnings call, $110.63 to close it, up just over $1. Budweiser and Bud Light continue to lose U.S. market share as the number one selling beers in the U.S. start to slip a little bit as maybe the taste buds of American beer consumers starts to evolve a little bit and move past that Sunday night football beer onto a more flavorful palate. Who knows?
Right.
We've seen the craft beer industry picking up quite a bit in the last few years. But cost cutting helped to make the USA even more profitable than it was in the previous year for Anheuser Busch InBev. So regardless of Budweiser and Bud Light sales going down in the U.S., cost cutting helps to keep them significantly profitable. Growth in Brazil is their big growth number. The Brazilians, they love their beer.
Yeah, they do.
They're big into soccer. They're big into drinking. Yeah,
of
they
course,
love it. Yeah,
of course.
SAB Miller, the company they bought a few years ago, about a year ago. Obviously, Miller Lite, all those companies, beer companies, helping the revenue growth. So we've seen that revenue growth up 2.8%. That's what's helping SAB Miller, helping Anheuser Busch InBev continue to grow as they fight the good fight against Brown-Forman, Diageo. I mean, there's only a couple companies out there.
Does Constellation Brands only have Corona?
Constellation Brands? I mean, there's a well, they're big. They have a lot of liquor, but they're not near the size, obviously, as a Molson Coors or an Anheuser Busch InBev. Sure. Yeah. So, Best Buy, probably the best earnings call of the week.
Really?
And they got smashed too. $2.42 a share, beat the street by 39 cents. $15.36 billion in revs, beat the street by 870 million. That rev number up 13.9% year over year. Why? Appliance sales up 21%. Mobile and computing up 9.6%. International sales, that's us for Best Buy's up here in Canada, up 9.9%. Best Buy started their earnings call at $75.50. They beat EPS by 39 cents. $75.50. They closed the week at $73.04, dropping $2.50. One more stat, though, the most important stat in retail, regardless of appliances being up and the yada yada, comparable store sales of 9% growth versus 3% estimate. How did Best Buy not get a bump off that? I don't even like retail. I don't like Best Buy. I don't think that's going to work in the long run, but that right there.
That was pretty good.
Comp store sales up 9% versus estimates. I don't care it was through the holiday season. The estimates were the estimates. They were done by people who know what they're doing.
3% was their estimate.
3% was the estimate.
They got 9.
They tripled the estimate.
Yeah.
Not too bad.
Not too bad at all.
Took $2.50 off the share price.
stopped doing so good, I guess.
Yeah, maybe.
I guess.
Maybe it was reverse week.
Maybe. Like crisscross kind of thing. Yeah.
Maybe it was like that Bizarro week or something.
Oh, was it? Yeah, it could have been.
Something in the air.
Something in there, yeah.
Kohls, another department store retailer, $1.99, beat by 24 cents. 6.78 billion, beat by 40 million, up 9.2% year over year. 66.50, roughly unchanged from earnings to the close. Comparable store sales growth, 6.3%. That is significant comp store sales growth. Like I was saying, at retail, that's your big number. That's any store that's been open over a year. Is considered an established store, and they add that into comparable store sales across an entire grouping of company stores. So when you see growth like that across an entire group of companies, like Kohls, you're growing. That's a lot. That's a lot of locations growing at 6.3%. Forward guidance for only 2% though in fiscal year 2018. So 6.3% last year in the last quarter. Comparable for over a year, right? But forward guidance for only 2%. Gross margins up 43 basis points to 33.8%. So gross margins getting a little bit better. Kohls, they're in that middle ground. That's a tough go. They're in with Nordstrom's and those other companies that are not ever going to compete with Walmart and not ever going to compete with a Target. They don't branch off near to the amount those other companies are, and they'll probably outlast the JCPennys and the Macy's of the world, or at least the JCPennys of the world. Macy's had good earnings this week. I don't actually have it written down. So they're going to outlive some of these companies, but they sit in that kind of the middle ground of things. And they're just, for me, when I'm doing any kind of investing, especially when we're talking retail, man, why wouldn't I own Home Depot?
Exactly.
Or Costco.
Yeah, the heavy hitters.
Those are the things I think of. I don't think of owning Kohls, despite how good the earnings call is. So 66.50, unchanged. The market didn't care, and when the market doesn't care in a week like this, when the market seems to care about even the bad stuff, even the good stuff. Gap, 61 cents, beat by 3, 4.78 billion, beat by 110 million, 7.9% year-over-year growth at Gap. 31.70, they closed at 34.18. 5.2% comparable store sales across the Gap brands. That number is growing exponentially at Old Navy as it continues to grow. Significant 9% comp store sales growth at Old Navy. Banana Republic 1%. Gap was flat. So growth at Old Navy, propelling Gap. Stock price went up. Good revenue growth, 7.9% year over year. Equifax, the final earnings call of this page, $1.39 a share. Jesus, I'm just trying to get out of this podcast,
great.
I'm done. I don't even care. I don't even care. You know what? I'm not even telling you these last three. It's a secret. Equifax, $1.39 a share, beat by 4 cents. $838 million. Beat by 12.81 million. There's growth, 4.7% growth in revenue. So Equifax coming off that, stolen. Everybody's stolen identities, right? They lost everybody's identity. They lost $30 in share price plus everybody's identity.
How many did you lose? Like 300,000 or something like that?
It was a lot.
I couldn't remember the numbers.
It was a lot of millions of people. Yeah, Equifax, a blunder to say the least. $111.50 when earnings was reported, $117.23 to close the week. Equifax still has a long ways to go to get back to where they were trading before the identity theft issue, but they are definitely making their way there, as it seems like, other than some fines that are definitely going to be levied against them at some point.
Oh, I can imagine, right?
The public storm, the sentiment has settled. And people have sort of forgotten that took place. Yeah. As when it happened, there wasn't a whole lot of news going on, and Equifax took a lot of front page bludgeoning.
Yes, they did. Yeah.
So I flipped the page.
You did.
Turns out, couple more earnings, couple more companies happen to report some earnings this week, and
a couple.
I've thought about giving them to you, but I'm still a little trepidatious, thinking I might just end this podcast here. And do you really need to know about Foot Locker?
Yeah, I do, actually.
You want to know about Foot Locker?
I do want to know about Foot Locker.
I like the Foot Locker actually by
Yes.
our house. It seems to be doing better. Some of the colors of the shoes have expanded.
Ooh, really? Because we were
Yeah.
talking about Foot Locker about
Kind
6 months ago.
of
We're
a
gonna
bland
Yeah,
palette.
yeah.
Foot Locker $1.26 beat the street by 1 cent. $2.21 billion, missed by 10 million. The revenue number up 4.7% year over year. $46 is where Foot Locker was trading at. $40 is where they're trading at now. Comparable store sales dropped 3.7% year over year. The 2018 outlook is flat for comp store growth. Foot Locker, yeah, you can buy shoes on the internet once you know your foot size.
Almost sounds like the nail in the coffin there almost.
We're getting there.
Yeah.
We're getting there.
Yeah.
Yeah. Retail, it's dicey. Let's put it that way.
Yeah.
JCPenny, big retailer, and the last actual earnings call of the day. 57 cents, beat the street by 10 cents, 4.03 billion in revenue, missed by 20 million, but up 1.8% year over year. $3.90 is what they were trading at when they reported earnings, $3.71 to close the week, so lost 19 cents on what is already a fairly low share price over at JCPenny, as another business, a retail business, is hanging on by their last threads of life. Comparable store sales grow 2.6% year over year. Jewelry, Sephora, footwear, and handbags were the top performer under the JCPenney umbrella. They reduced $600 million in debt in the past quarter, much like I've reduced all of my energy reserves talking about the stock market here this week, and I'm ready to go home and eat some dinner. Anthony, it was a pleasure doing podcast number 19.
Number 19.
With you here today on this beautiful sunny Sunday.
It is sunny.
And we got it done early, too.
We did.
It's only 4:15.
Yep.
What am I going to do with the rest of my day?
Eat.
Fentanyl. Oh, eat.
That's a better idea.
Oh, my. What did I say? Yes. No, eat is what I'm going to do.
Yes.
Yeah.
I'm gonna
It was a good podcast.
Yeah, we didn't really have too much to talk about, like for the news headlines, but I think we did pretty good.
Yeah, there just wasn't a whole lot of activity in the market. Like outside of the market responding to interest rates.
Yeah.
And, like the Fed talking and all that, and these U.S. steel tariff issues. There just really wasn't a whole lot of...
No.
Yeah, I mean, Amazon buying
I think
Ring
the Fed and the tariff kind of thing kind of took up the news this week.
Yeah, it really did.
Yeah.
And there wasn't a whole lot going on. It's been kind of a slow start to 2018.
It has.
There hasn't really been a whole lot of dust kicked up. For where the market's at, and I think we thought there was going to be a little more mergers and acquisitions. At least I personally thought that. You have a lot of companies right now sitting on a lot of cash. They've repatriated a lot of money or in the process of it. There's a lot of companies sitting on a lot of money and companies out there looking like they're... I mean, everybody's valued way to the premium side because right now valuations are just so high for everything. But there's a lot of companies, I think, that are looking to expand. And I thought by now we were going to see, other than the continuation of Broadcom, Qualcomm, and Time Warner, AT&T, I thought we were going to see some other real big moves, I guess. We thought Comcast was going to swoop in and try to get 21st Century Fox from Disney, but that seems to not be on the table now. So, yeah, maybe next week.
Maybe next week,
next week there'll be some more exciting news as earnings cools down. Now maybe everybody's been waiting to bring all their stuff right to the limelight.
All the goods.
They didn't want to be muffled out by the Etsy crafting earnings call.
No.
All those wicker baskets really take away the joie de vivre when you come to take over a $100 billion tech company, right?
Yeah,
so you don't want to
sure.
be doing that. You let the wicker basket have its moment in the sun, and then you swoop in at the end and then pick up the crumbs.
Oh yeah,
yeah,
for sure.
I'm Cody from Wall Street Breakdown.
I'm Anthony from Wall Street Breakdown.
This was podcast number 19. We thank you for joining us once again. We hope you're enjoying the podcast as well as the videos that we bring to you every week on YouTube. If you've got any suggestions, comments, we want you to drop us a line. Make sure you like, subscribe, and have yourselves an outstanding rest of your week and your life, for that matter, just in case you don't come back. Yeah.